Picture yourself walking to your mailbox on a typical afternoon, sorting through store advertisements and service bills, when you notice an official letter from the IRS. A wave of unease washes over you. Opening it, you anticipate perhaps a standard notification. Instead, you're looking at a fine, $10,000. And the hardest part, you're completely confused about what went wrong. You didn't conceal funds internationally. You didn't operate a hidden enterprise. You didn't falsify your tax documents. All you did was deposit some currency from selling your vehicle, or perhaps your child sent you funds to assist with healthcare costs, or you transferred money around to finally fix that aging roof. Entirely ordinary retirement behavior. However, in 2026, ordinary doesn't necessarily mean secure, because what's causing these fines isn't unlawful conduct, it's sequences. Sequences identified by computerized systems that don't understand your circumstances. And once that system determines something appears questionable, the fine can begin at $10,000 for a single infraction. Today, we're going to break down precisely what's occurring, why numerous retirees are being taken by surprise, and the one basic error that can transform an innocent banking visit into a governmental issue. Hello, I'm Sophia, and I dedicate my time assisting retirees safeguard the savings they work their whole lifetime to accumulate. And I must discuss with you something that has quietly shifted in the banking world this year. The regulation itself isn't recent. In truth, it's existed for many years. But the method it's being applied in 2026 is entirely different, quicker, computerized, and much more strict when something doesn't align perfectly. My purpose today isn't to frighten you. It's to ensure you comprehend what's actually happening. What type of routine banking behavior can cause a substantial fine, and most significantly, how to safeguard yourself so you never encounter that $10,000 shock. Because once you see how this operates, you'll recognize the risk isn't apparent, and that's precisely why we must discuss it. So, let's begin with the element that's catching people completely unprepared. The routine transactions that appear totally innocent on the surface. Imagine this. You sell your older pickup vehicle for $15,000 in currency. The purchaser arrives, counts it out, and you go to the bank to deposit it. Straightforward. Or maybe your son transfers you $20,000 to help cover some unanticipated healthcare costs. Or you finally take that single-sum pension withdrawal you've been considering for years, or you move a substantial portion of savings from one account to another because you're placing a payment on an RV. None of that is unlawful. None of that is questionable. It's just existence. It's retirement. It's your funds. But here's where things begin to change in 2026. Banks aren't simply holding your deposits. They're documenting certain kinds of behavior automatically, and those documents don't remain in a storage cabinet somewhere gathering dust. They're being examined, organized, and compared by systems that are built to locate discrepancies. So, when a substantial amount of currency suddenly shows up in your account, the system doesn't recognize vehicle sale or contribution from child or retirement withdrawal. It recognizes numbers. It recognizes sequences. And if those sequences don't correspond with what's on your tax documents or other banking records, it raises a digital concern. This is the element that feels unjust to many retirees because from your viewpoint, you're just handling your finances responsibly. But from the system's viewpoint, it's asking one very particular question. Where did this money originate? And was it correctly documented? And if the response isn't perfectly clear in the information it has access to, that's when difficulties can begin. Now, here's the development that surprises almost everyone. The regulation behind all of this isn't recent, not even remotely. In truth, it's existed for many years. What's shifted is how forcefully, and how capably it's being applied. At the foundation of this is something called a Currency Transaction Report, or CTR. And despite how intimidating that sounds, it's actually very basic. By regulation, banks are obligated to file a CTR whenever someone makes a currency transaction over $10,000. That includes currency deposits, currency withdrawals, even particular kinds of transfers. So, if you walk into your bank and deposit $12,000 in currency, the bank completes a form and submits it to the government. You don't complete it. You don't even necessarily observe it. It happens behind the scenes. And here's what's significant. A CTR is not a fine. It's not an allegation. It's not a sign you did something incorrect. Millions of these documents are filed every year. For many years, this has been standard. Business operators deposit currency. People sell vehicles. Families move funds around, the bank files the form, and existence continues. So, if that's been the regulation for years, why are retirees suddenly hearing about $10,000 fines? Because in the past, these documents mostly just remained there unless a human examiner had a reason to look closer. Today, that's no longer the situation. Now those CTRs are immediately fed into computerized systems that compare them against tax documents, social security records, pension distributions, and other banking information. The system isn't just gathering information anymore, it's evaluating it in real time. And when it locates something that doesn't align, that's when the difficulty begins. But there's another dimension to this, one that's even more risky than a simple substantial deposit. It's an error that well-intentioned people make all the time, thinking they're actually being clever. And in the perspective of the IRS, that single choice can transform a completely lawful transaction into a governmental infraction. That's what we're exploring next. Here's where everything shifts and where many honest, law-following retirees accidentally step into risky territory. Let's say you have $12,000 in currency. Maybe it's from selling a boat. Maybe it's savings you kept at home. Maybe it's funds you've had for years and just never deposited. You walk into the bank and right before you step up to the counter, a little voice in your mind says, "If I deposit all of this at once, they'll document it. I don't want any additional attention, so instead you deposit $8,000 on Monday, then you return Wednesday and deposit the remaining $4,000. From your viewpoint, that feels harmless, responsible even. You're not concealing earnings. You're not evading taxes. You just don't want documentation filed with the government. That seems logical, right? But in the perspective of governmental regulation, that choice can completely alter the situation. This is something called structuring. Structuring occurs when someone deliberately breaks up a substantial currency transaction into smaller amounts for the intention of avoiding that $10,000 documentation requirement. And here's the element that catches people unprepared. The funds itself doesn't have to be unlawful. It doesn't matter if it came from your pension, the sale of personal belongings, or a contribution from family. If the deposits are divided particularly to avoid causing a currency transaction report, that action alone can be considered a governmental infraction, and yes, fines for structuring can begin at $10,000 per infraction. Now, let's contrast this clearly, because this is essential. If you walk into the bank and deposit $12,000 in currency in one single transaction, the bank files a CTR. That's it. Standard, lawful, no violation, no fine. In most situations, nothing further occurs, but if you deliberately deposit $8,000 and then $4,000 particularly to avoid that document, you've just created a sequence that computerized systems are built to identify. And those systems are very capable at recognizing sequences. They look at timing. They look at amounts. They look at series of transactions over days or weeks. If it appears like the deposits were organized to remain under the documentation threshold, that's when red flags escalate rapidly, and here's the uncomfortable reality. The system doesn't read your thoughts. It doesn't understand you were simply attempting to avoid additional attention. It only recognizes the sequence, and the sequence is what matters. This is where numerous good people get into difficulty. They think they're being cautious, they think they're staying off some imaginary monitoring, but in reality, breaking up deposits to avoid documentation is precisely what places them on the monitoring. Let me say this as clearly as achievable. Filing a currency transaction report is not a difficulty. Attempting to avoid one can be, and this is the change occurring in 2026. With advanced computerization, cross-referencing, and real-time evaluation, these sequences aren't slipping through the openings anymore. The system doesn't require a human examiner sitting at a workstation. It identifies discrepancies immediately. It links deposits to tax documents. It compares documented earnings to currency behavior, and when something doesn't align, notifications go out automatically. Now, before you let this spiral into worry, take a breath. The IRS is not focusing on retirees who are simply handling normal finances. The overwhelming majority of people who deposit funds correctly, even substantial amounts, never face an issue. The real risk is misunderstanding the regulation, so here's the first major point. Never divide a transaction just to remain under $10,000. If you have more than $10,000 in legitimate currency, deposit it in one transaction. Let the bank file the document. That's what the system anticipates. That's what keeps everything proper. If this is already helping clarify things for you, take a quick second to like the video and subscribe. I share information like this particularly to help retirees avoid costly errors before they occur, not after. Because now that you comprehend structuring, we need to discuss something just as significant: how to safeguard yourself moving ahead. What simple practices can ensure that even in this fully computerized IRS setting, you're never caught scrambling to explain your own funds? That's precisely what we're addressing next. Now that you comprehend where the real danger is, let's move from awareness to safeguarding. Because this isn't about alarm, it's about readiness. The application setting in 2026 may be more computerized, quicker, and less forgiving of discrepancies, but the method you safeguard yourself is surprisingly basic. It doesn't demand complicated legal approaches or costly shortcuts. It demands organization, precision, and a documentation trail. So, here's the first action, and honestly, this is the most effective one. Document everything. Whenever a substantial sum of funds moves in or out of your accounts, you want records that clearly explain where it originated. If you sell your vehicle for $15,000, keep a signed sale agreement. Make a duplicate, digitize it, store it somewhere secure. If your child gives you $20,000 to help with healthcare costs, ask her to write a simple contribution letter stating the amount and that it's a contribution, not earnings or a debt. If you take a single SIM pension withdrawal, keep the distribution documentation. If you withdraw currency for a substantial purchase, keep invoices and receipts. The objective is basic. If anyone ever inquires, you can immediately show the origin and intention of the funds. Because here's what most retirees don't recognize. The IRS computer doesn't automatically understand the context of your transactions. It recognizes numbers. Your documentation provides the narrative behind those numbers, and when the narrative is clear and supported by documentation, issues tend to resolve rapidly. Step 2. If your banking existence is more intricate than just Social Security and a small pension, this is the year to meet with a qualified tax specialist. A good CPA doesn't just file forms. They help ensure your tax documents tell a complete, consistent narrative. If you had a substantial deposit from selling belongings, that needs to correspond with what's documented. If you received a considerable contribution, they can help ensure everything is documented correctly. Computerization identifies mismatches. A tax specialist helps prevent them before they occur. And step 3, communicate openly with your bank. This one surprises people. There's no disadvantage in asking your bank about their documentation policies. In truth, openness works in your benefit. If you're planning to deposit a substantial amount of legitimate currency, you can simply do it correctly and let them file the required document. Remember, a currency transaction report is standard. It's not an allegation. Attempting to avoid it is what creates danger. When you combine these 3 practices, documentation, specialist guidance when needed, and openness, you dramatically reduce your chances of ever facing that $10,000 shock. Let's pause for a moment and put this into viewpoint. The computerized systems in 2026 are capable. Yes, they link information immediately. They cross-reference deposits with tax filings. They recognize sequences humans might overlook, but they are still data-driven systems. They rely on uniformity. When your records are organized and your transactions are direct, you're operating precisely the method the system anticipates. This isn't about concealing, it's about precision. And if you know another retiree, maybe a friend, a relative, someone in your circle who still thinks breaking up deposits is a clever move, share this with them. A simple misunderstanding could cost someone $10,000 or more, because the reality is, the banking world has shifted. The previous method of doing things where small discrepancies might slip by unnoticed is disappearing rapidly. We're now existing in a fully electronic application era, and the people who adjust early are the ones who avoid unnecessary pressure, which brings us to the broader perspective. Here's the broader perspective you need to comprehend. The application change we're observing in 2026 isn't temporary. It's not a trial initiative. It's not something that's disappearing next year. Computerization is now embedded into how banking monitoring operates. The systems are quicker, they're more linked, and they're built to operate continuously in the background. That means the retirees who are most at danger aren't the ones doing anything unlawful, it's the ones operating under outdated beliefs. For years, many people believed that if something didn't immediately raise concerns at the bank, it probably wasn't a significant issue. If you kept deposits small, stayed under the monitoring, or handled things quietly, you were being cautious. But in today's setting, attempting to stay under the monitoring is precisely what creates the monitoring signature. That's the contradiction. One direct $15,000 deposit with correct documentation. Standard, recorded, processed, forgotten, multiple smaller deposits made deliberately to avoid documentation, sequence identified, concern caused, questions generated. The system isn't emotional, it doesn't assume wrongdoing, but it does assume that sequences meant to avoid documentation deserve examination, and once that examination begins, it can be demanding, time-consuming, and costly to resolve. Now, I want to ground this in confidence. Most retirees watching this will never face a structuring fine. Most substantial deposits, when done correctly and supported by records, pass through the system without incident. The objective here isn't to make you nervous every time you walk into a bank. The objective is to replace uncertainty with precision, because precision changes how you act. When you comprehend that a currency transaction report is normal, you stop fearing it. When you comprehend that structuring is about intention to avoid documentation, you stop accidentally creating risky sequences. When you comprehend that documentation tells your banking narrative, you start keeping the type of records that safeguard you automatically. This is really about perspective. The previous perspective was, keep it quiet. The new perspective needs to be, keep it documented. That single change can save you enormous pressure. So here's the question I want you to seriously consider. If a fully electronic IRS system reviewed your last 12 months of banking behavior, would the narrative make sense on documentation? Would every substantial deposit have a clear explanation? Would every movement of funds correspond with what's documented on your tax documents? If the response is yes, you're operating precisely where you need to be. If the response is I'm not certain, then now is the ideal time to organize, to file documentation correctly, to digitize documents, to meet with a tax specialist if needed, and to address anything that feels unclear. Not because you're in difficulty, but because readiness is far less costly than fines. You worked many years to build your retirement savings. You sacrificed, you planned, you made careful choices so you could enjoy this phase of existence with stability and peace of mind. The last thing you want is a preventable $10,000 fine because of a misunderstanding about how banking documentation operates. The regulations themselves haven't drastically shifted. What's shifted is the velocity, the visibility, and the computerization behind application, and the retirees who succeed in this new setting aren't the ones who alarm. They're the ones who adjust. So deposit substantial amounts correctly. Never divide transactions to avoid documentation. Keep documentation for significant banking events. Ensure your tax documents reflect your reality, and treat openness as safeguarding, not vulnerability. Because when your banking documentation trail is clear, organized, and consistent, computerized systems have nothing to question. And that's where peace of mind exists.